Investing in the U.S. stock market in 2026 like in 2020 is risky. This is not a hype video. This is a beginner's guide for the next market cycle. If you're 22 to 40 and want your money to grow, you're in the right place. 2026 is not a normal investing year. Interest rates may fluctuate. AI is replacing white-collar jobs, geopolitical tension is reshaping supply chains, and the U.S. stock market is no longer rewarding blind optimism. Beginners fail not because they choose bad stocks, but because they invest with outdated assumptions. In 2026, safety, cash flow, and pricing power matter more than hype. The S&P 500 still dominates global capital, but volatility is higher. Corrections are faster, and emotional investors lose money quickly. This is why smart beginners focus on quality U.S. stocks with strong balance sheets, predictable revenue, and real-world dominance. Fear is rational in uncertain markets, but paralysis is expensive. Inflation may cool, but living costs remain high. This creates a psychological trap. People wait for perfect timing and miss compounding years. The smartest beginner strategy in 2026 is not trading, it's structured accumulation. Dollar-cost averaging into dominant U.S. companies allows you to survive crashes and benefit from recoveries. Remember, the stock market transfers money from the impatient to the disciplined. Your edge is not speed, it's consistency. Now that you understand the danger, let's talk protection. Blue-chip stocks are not boring. They are defensive weapons. In 2026, companies with global dominance, strong cash reserves, and pricing power outperform speculative plays during uncertainty. Think Apple, Microsoft, Johnson & Johnson, and Coca-Cola. These companies survive recessions, pay dividends, and adapt faster than smaller competitors. Beginners often underestimate how powerful stability becomes during market stress. When panic hits, institutions rotate capital into blue chips, pushing their prices higher while risky stocks collapse. Psychologically, blue chip investing protects beginners from emotional mistakes. Watching speculative stocks drop 40% destroys discipline. Blue chips fall less, recover faster, and reward patience. Many also benefit from AI adoption, automation, and global consumption trends without depending on hype cycles. In 2026, owning fewer, stronger stocks beats owning many weak ones. This strategy aligns with how wealthy Americans actually invest, quietly, patiently, and repeatedly. Beginners should not chase overnight returns. They should build portfolios that survive decades. Once that base is strong, growth layers can be added. But safety alone isn't enough. Growth still matters. Growth stocks in 2026 are no longer about hype. They are about infrastructure. AI, cloud computing, cybersecurity, and semiconductors form the backbone of the modern U.S. economy. Companies like NVIDIA, Microsoft, Amazon, and Google are not trends, they are systems. Beginners often fear growth stocks due to volatility, but avoiding them entirely creates long-term underperformance. The key is selective exposure. AI is not a bubble, but valuation discipline matters. Investors must understand earnings, free cash flow, and long-term demand. Growth stocks reward patience when bought during pullbacks, not euphoric peaks. For beginners, allocating a controlled percentage of capital to proven growth leaders balances upside with safety. Psychologically, growth investing keeps beginners engaged and hopeful, which increases consistency. When investors believe in the future, they stay invested longer. That alone improves outcomes dramatically. Growth is powerful, but trends decide winners. Dividend stocks are psychological anchors. In uncertain times, cash payments reduce fear and reinforce discipline. Utilities, Consumer staples, healthcare, and energy stocks often provide reliable dividends even during downturns. In 2026, dividend investing is not old-fashioned, it's stabilizing. Receiving income while holding assets changes investor behavior. Beginners panic less. They sell less. They compound more. Dividend reinvestment quietly builds wealth over time, especially when prices fall. This strategy aligns with how retirement portfolios are built in the U.S. But dividends alone won't beat inflation. Avoid meme stocks, influencer tips, and overtrading. Most beginners lose money due to activity, not ignorance. In 2026, information overload is the enemy. Simplicity wins. Avoid leverage. Avoid panic selling. Avoid chasing headlines. Now, let's build your actual beginner strategy. Simple portfolio beats complexity. Combine blue chips, growth leaders, dividend stocks, and ETFs. Invest monthly. Stay boring. Win quietly. In the next video, we'll show exact allocation, so subscribe our channel to get notifications in time.